Welcome to Unit 4, the income statement. In Unit 4, students will demonstrate skills necessary to classify items as revenue or expense. They'll learn how to prepare an income statement. They'll be able to explain the time period principle and the matching principle. They'll use the accrual basis of accounting for revenue and expenses, and they'll be able to explain the cash basis of accounting. This unit is quite short. It'll only take 2 or 3 classes to complete, and you will have the Unit 4 test in approximately 3 classes. Let's take a look at the purpose of accounting. We've already discussed this in the past. The purpose is to use a system that will provide financial information that can be used to make decisions. Owners, managers, investors, bankers, the government can all use this information to help them make decisions. There's 2 types of accounting activities: recording the daily transactions and preparing reports that summarize those daily transactions. Up until now, we are very competent at recording daily transactions. We know how to prepare a balance sheet. Now we're going to take a look at an income statement. We're going to learn how and why we use an income statement. First of all, we have to talk about profit and loss and get the definitions of these. Profit is the increase in owner's equity that results from the successful operation of a business. You need to know this definition. Loss is the decrease in owner's equity that results from the less than successful operation of a business. Along with profit and loss, we have to take into consideration revenue and expenses. The definition of revenue is amounts earned from the sale of goods or services during the routine operation of a business. Please memorize this definition. Expenses are the costs of goods or services used up in the routine operation of a business, such as salaries expenses, advertising expenses, delivery expenses, and so on. How do we determine profit or loss? Let's take a look at an example. We have a television set that is selling for $500. The store that is selling this television set spent $400 to acquire the TV, advertise for the sale of the TV, and pay a salesperson to sell the TV. If we use the formula revenue minus expenses equals profit or loss, we can say that the $500 is the revenue, the value of the funds taken in when we sold the TV, and we subtract the costs associated with selling the TV, which in this case were $400, and we have a profit of $100. In accounting terms, revenue minus expenses equals net income or net loss. 500 minus 400 equals $100 net income. Let's take a look at the income statement itself. It presents the revenue, expenses, and net income or net loss for a specific period of time. Now this is really important right here. Period of time. What is the accounting period? That's the period of time that is covered by financial statements. Up until now, when we had balance sheets, we put a specific date. But now when we prepare income statements, we have to take into consideration the whole period, the accounting period. Another name for accounting period is fiscal period. You need to know this term. It's interchangeable with accounting period, and you'll hear about it a lot if you listen to television or radio reports. They quite often talk about fiscal period. So, what is the structure of the income statement? First of all, we have the heading. Just like the balance sheet, we ask who, what, and when. Then we have a section for revenue, Then we have another section for expenses, and that results in a net income or net loss. There are 4 steps in preparation of an income statement. The heading, the who is the business name, the what is the income statement, and the when is the accounting period. Once again, I want to emphasize, this is not a particular date, it is the period of time covered by these financial statements, or in other words, the accounting period. Here's an example. Goldman's Gym. That's the who. The what is the income statement. That's the document we're preparing. And here's the really important part. You must use these words. For the month ended, and then you put the date that this accounting period has ended. If you don't include for the month ended, you will lose marks on any of the tests or assignments that we do. Part 2, you prepare the revenue section first. So you have to have the title that is called revenue. Then you list each of the different revenue accounts. In this example here, we have member fees, tanning bed rental, and towel rentals. In the column next to that, you list the value of these accounts. The last thing that we do in the revenue section is to total up all the revenue. So we use the title Total Revenue. The total goes in the next column to the right of where each individual account value is. And because it's at the top, we put a dollar sign. It's at the top of this column. It's the first item entered. Don't forget to put the single line to indicate that addition and subtraction is going to occur. Even though it's in the line or in the column adjacent, we still need to have this line right here. Next, step 3, we prepare the expenses section. We have the title for the expenses called expenses. Then we list the accounts that are part of the expenses, and in the next column we list their amounts. The first item in this section needs to have a dollar sign. At the bottom of the expenses section, we put the total expenses and its amount. Now, because we had an amount total for the revenue, we don't need a dollar sign here for the total expenses. Once again, we have to have a single underline to indicate addition is occurring, and we put the total in the next adjacent column. Then we determine the net income or the net loss. We take the value of the revenue and we subtract the value of the expenses, and this gives us our net income. If the revenue is greater than the expenses, it's net income. If the total of the expenses is greater than the revenue, we will have a net loss. Speaking of net loss, let's talk about net income and net loss. Net income is the difference between revenue and expenses when revenue is greater than expenses. Net loss is the difference between revenue and expenses when expenses are greater than revenue. Please notice the difference. Revenue is greater if we have net income. Expenses are greater if we have a net loss. Let's take a little test to see if we understand the idea of net income and net loss. In example A, we have $100,000 in revenue, $70,000 in expenses. What would the net income or net loss be? That's right, $30,000 net income. The next one, $20,000 revenue and $19,500 in expenses. The net income, $500. The next example, we have revenue of $31,000, and this time we have expenses that's greater. It's $35,000. So, do we have a net income or a net loss? Because the expenses are greater, we have a net loss. Please notice, when we have a net loss, we surround the number with parentheses. Part D, 14,000 revenue, 11,000 expenses. That's a $3,000 net income. Last one, 28,000 revenue, 30,000 expenses. That results in a $2,000 net loss. Once again, notice the parentheses. When revenue is greater than expenses, there is net income. When expenses are greater than revenue, there is net loss. Your assignment for today is to complete questions 1 to 7 on page 73 in your textbook, and you can answer these on the Accounting 11 website, and do exercises 1 to 3 on page 73 and 74, and those answers can be done in your workbook. Trial balance preparation. A trial balance is a list of all the accounts with their current balances. It's prepared to verify that the total debits are still equal to the total credits. It's considered to be an informal statement. It's a tool to be used within the business. This means abbreviations are acceptable, but neatness is still important. How do we prepare a trial balance? Like our other statements, we start with a heading. We ask ourselves who, what, and when. In this example, the who is Goldman's Gym. The what is a trial balance. That's what we are preparing. And the date is the current date. The accounts are listed in the order that they appear in the ledger. 2 columns are required to list all these balances. The first column on the left is used to record the debit balances. The second column is used to record the credit balances. Here's an example of a trial balance. Notice that the name of the account is in the column on the left underneath the title Account. We don't use the account numbers yet. And then the third column is for debits, and we put in the amount of the cash account. And because it's an asset, there is no credit balance, so we leave that blank. Then we complete all the other accounts. Accounts receivable, supplies, equipment, and so on. So we put the debit accounts, the ones that have a debit balance, in the debit column, and we put all the ones with a credit balance in the credit column. When we total these up, we should have a total in the debit column that equals a total in the credit column. There are some limitations for trial balances. They only show the mathematical accuracy of the ledger. It shows that the debits are equal to the credits. It shows that double entry accounting was indeed used. However, it does not show if the wrong accounts were used to record a transaction. You may have the right debit amount, but it may be in the incorrect account. And similarly, you may have the right credit amount, but it may be in the wrong account. In order to prepare the trial balance, the information on the general ledger must be used. So we must take a look always at the balances in the general ledger and transpose those onto the trial balance. Here's an example. Here's the cash account. We see that the balance is $10,585. We take this balance and we transfer it over to the trial balance. In class, we're going to complete exercise 3D, which is on page 52 in the text and page 20 in your workbook. And in a moment, we'll discuss the answer. Please pause the presentation and start it up again when you're finished exercise 3D. Welcome back. Here we are now taking a look at the answer to the trial balance for Dominicana Restaurant. Here is the trial balance where we list all the accounts: cash, supplies, land, building, equipment, accounts payable, mortgage payable, and the capital account. Notice that the ones with the debit balances have their amounts listed under the debit column. The credit balance accounts have theirs listed in the credit column. When we total all the debits, we get an answer of $306,920. Similarly, we get the same answer underneath the credits. If your trial balance has this answer in both the debit and the credit column, you did this 3D perfectly. How do we prepare a new balance sheet? After the trial balance has been completed, it's now possible to make a new balance sheet to show the new transactions that have occurred during the last accounting period. The balance sheet is created using the balances from the trial balance. So as we said earlier, the trial balance is a tool. We check the mathematical accuracy of all of our transactions, and once we're satisfied the debits and the credits are equal, we can now prepare a new balance sheet. In review, we must use the most current balance sheet to prepare the T accounts in the general ledger. We must ensure that the debits and credits are entered correctly. We add transactions during the accounting period as they occur. And we determine the balances for each account once the accounting period has ended. From this, we prepare a trial balance. We take all the balances of all the accounts and use it to prepare the trial balance. Your assignment is to read Part 2 from pages 41 to 44, then do questions 6 to 8 on the web page for Accounting 11, and do exercise 4 in your workbooks.